Rob's Child here with Chapter 12 of Security Analysis. Nothing I say is investment advice, and I'm intending with these videos to supplement and discuss the chapters, not in any way replace any of the content. So today's chapter 12, we're still in fixed investment, focuses greatly on railroad bonds. As we've talked about before, railroads were a major industry, a major investment type in this time period, and so we go over many details regarding those things. So let's just dive right into it. The title is Special Factors in the Analysis of Railroad and Public Utility Bonds. So I think this chapter basically only they cover more on the railroad side of things than the utility bonds, but he does discuss both. So we start the chapter by discussing, there's a chart going over all of the potential things you need to think about with the costs of operating a railroad company. And he says for the individual, let's just keep it simple. Let's use what we learned. Let's use the basics. We don't need to necessarily know every detail. This is something he's repeated over and over again, especially regarding qualitative data. You could read books and books about a company that has information that's actually not useful. And, one of his, I think, goals of writing this book is to get people focused on what's important and be able to ignore what's not important or less, of little importance compared to what's really important when it comes to investing. And as we're discussing, in this part of the book, mainly fixed value investing, although he is bringing up in the book more and more he mentioning occasions when it's good to start looking at the stock of a company. He does kind of poke into that area a little bit, but the focus again still is fixed income here. So to reiterate the importance of safety, if you're looking at purchasing a railroad bond in the 1940s, if it yields only a little bit more than a treasury bond and there's just like a hint of this might not be safe, go with the treasury bond. Don't go with the corporate bond, obviously. I think that discussion can be held about corporate bonds today. We're currently in just beginning July 2023. And we've just gone through a super aggressive hike cycle from interest rates from the Fed. And along with that, 30-year bond rates went from something like 0.7% to it peaked at 4.4%. Now we're around 3.9%. And, I don't look directly at corporate bonds, but I can just imagine how much chaos that's got to be, especially when we keep talking about times covered interest payments, that's an important metric for companies to be able to have. When you're going from 0.7% on the 30-year treasury bond to 3, that's a multiple of, 4 or something like that. And so if you multiply, just on a T-bond, you're multiplying what's owed in interest by 4. It probably has a similar ratio, I can imagine, to corporate bonds. And so all of a sudden, corporations holding debt are going to be owing so much more, comparatively, anyway, this whole chapter is just making me realize, this whole section of this book is making me realize how crazy it is for debt to go up that quickly. And now I can understand better why so many further dated, like ARK investments have gone down so much. The relation it has to the coverageability of interest payments just expands so much that like the valuation of the stock naturally would come down. So finally, I'm starting to understand how that all relates. So just going through a few more points in this chapter, he mentions how the cost of various services can change is one of the potential stresses that a company can have for its ability to pay its interest payments. I mean, that's largely what this chapter is about, is what things lead to and can lead to more stress on being able to pay their interest on their bonds. He mentions in here, next point I wanted to bring up was that he doesn't like special dividends. He doesn't like seeing a company have a buildup of cash and be like, oh, here you go, shareholders. We earned a ton of money this year. That's very understandable, especially from the bondholders' perspective. If a company is able, the way I think of it is, if a company is able to make that much better earnings in 1 year because of some crazy circumstances, similarly to an example I brought up, Star Bulk Carriers having their dividends suddenly go way up. It's something to look at with caution. And I say that because obviously, the prices of everything goes up and down. And just because you had a great year and earned all this money, I mean, in a way that may be foretelling that the company is going to be making like nothing for the next however many years, or so a special dividend, he doesn't like it, and I can understand that perspective very well, why that wouldn't be so safe feeling, especially for not just the bondholder, but for the stockholder. If they can't pay their interest payments, they're putting themselves at risk for bankruptcy just at that point. And just to put out a special dividend. And this also goes for companies that, I think this relates to companies that always make sure they're paying their stock dividends so that they can maintain the status in funds and in people's minds that they're always going to pay. And then, all of a sudden they're not even making enough money to be able to pay it, and they're still paying it out because they're assuming they're going to get it in the future. That's also, in my mind, kind of a dangerous situation. You don't want your company being overly giving with the extra earnings, with the dividends. I think this relates also to the idea of averaging earnings and, calculating, well, we should be imagining that the average is going to remain true. If a graph all of a sudden goes up like this, it's pretty inevitable most of the time it goes back to the mean, back to the, moving day average, long-term moving day averages, for example. So moving on to a few more points, he brings up how, again, this was brought up earlier in the book. He goes into specifics, of course, but the general idea is there's certain accounting cheats that have basically been made that he doesn't like. And then the next point, safety is more about what's going on right now in the company and what has gone on in the past, and that speculation of the future, he says, should help you be more cautious. If your speculation is, oh, this company is going to go to the moon, this is an area where he's like, be cautious. And we keep going on. Trains. One part of this as well, he says, in railroads, speculative bonds often are an equivalent of getting a speculative stock. And he's mentioned this before. I've mentioned this before in other videos, how, if you're getting a bond 90% off, there's a good chance that you're better off buying the stock at that point, just as an example. And in this specific place, he's talking about with accounting risks and quantitative data. So next point, this is when we get more into the utilities section, which he touches on, and he mentions in here that from 1926 to 1929, there's a whole section, there's a subtitle in there about how the term public utilities got abused. And the idea here is that, when a company is doing multiple businesses, or, they just have a small part in public utilities, and then they give themselves the title public utilities in order to get that special place in people's hearts that, this is safe because it's a public utility, even though they're doing other businesses, other business. That's a problem. And, this is something I see today in ETFs, how they're pretty clear today. I think that most of the ETFs are pretty good in regard to this specifically. I'll see, like, especially these specialty ETFs, they say, more than 50% of the business has to come from this thing. And, whether it's a Bitcoin ETF or some other specialized industry. And then we keep going on about safety. And then another idea he brings up is, when we're looking at the value of the stuff a company owns, again, he talks a lot about depreciation, but not only that, old technology gets replaced. Old technology loses its value greatly oftentimes when a new, better technology comes out. And this includes, railroads. Just look out there in the world today. Look at all the trucks on highways. Not everything is moved by trains today. And then not only that, we have these giant ships that I'm sure are carrying more goods than they've ever have before across the ocean. And so, you always have to keep in mind, whatever you're invested in, that a new technology can make whatever technology you are looking at obsolete. I mean, people have been saying recently, this relates to Google and AI, the idea that some of these AI companies may make Google obsolete. How many times do you hear people say, oh, just Google it, just Google it? In the future, we might not be saying that anymore. We might be saying just chat GPT it, or whichever model, comes and dominates the AI industry. Search engines will be obsolete in a lot of ways. And so those are things to think about related to this chapter. He goes on to complain about the omission of depreciation charges and how it has a real cost for companies. And I guess these flyers were being advertised for selling bonds of certain companies, and they were leaving this information out. And he said, that's not okay, guys. You have to include your depreciation. It's a real cost. The value of the stuff you bought, you sold the bonds, you got the money, you bought these things. These things don't retain the same value over time. They usually depreciate. They usually go down in value for the stuff. Land can go up, but that's another discussion. It can go up and down. And that brings me to another point I wanted to bring up with book value. When you see book value, I've learned about book value. I'm looking at stocks. I'm like, oh, this thing has a book value of only 1. Oh, this has a book value of 2. I often wonder now how much of this book value is in just the land that they own, that their offices are on, or that their factories are on, or whatever it is that they own. And I mean, prices of real estate having skyrocketed greatly, I think, for a while now, tells me that, maybe these book values, if we end up in another financial crisis and we have the value of the land go down by 90%, well, guess what happens to that? That automatically, that book value goes from 1 to 10. And so, book value is great, but you got to take it with a huge grain of salt. And that's something that I kind of extracted from reading this. So we finished the chapter with talking about how interest not being taxed, so you don't need to include that in how well interest is coveraged, like how many times. I'm sure you're familiar with this in the book. He just goes over it over and over and over. It's all about how, what time the earnings is what times of the interest payments, and that gives you an idea of how safe the bond is, just as a general rule. And then different safety margins are appropriate for different industries. And then a stipulation that, unless the bonds are somehow junior, because of the structure of the way the investments work, if they're junior to post-preferred share payments, which apparently can happen, that's taxed. That's the only case where that's taxed. And, overall, the big point of this chapter from the beginning and the end, don't make it more complicated than it needs to be. Make it just complicated enough, and try to not get cheated out by fake numbers from accounting, and use speculation to help you be more safe, not more risky. And I think those are the main lessons that I pull out of this chapter. Chapter 12 of Security Analysis. I hope you enjoyed this episode. Please discuss in the comments below. Rob's Child.